The one thing I've always said, which could change my price trajectory, would be a political reaction. We've just had the biggest political reaction you could have. And what have they done? They've tightened things further.
And for me, if I look at price, once it breaks €100 again, this thing's just much like when we first spoke about this things, it had been consolidating and then it had exploded higher. Just feels the same thing. So I think let's frame the carbon market first for those people who don't fully understand it, because everybody gets confused with carbon offsets, carbon credits, the EUTS, all of these different things. So let's get people on the right page first.
Well, okay, I'll tell you what, I'll share a slide because I put this little fellow together. So this is contrasting the EUAs and the voluntary carbon market. And this is where the confusion starts. Everyone tends to think of carbon as carbon offsets. In other words, it is plant a forest, grow some trees, that kind of thing. That is a completely different animal to what I'm talking about. And what I'm talking about is the European Emission Trading Scheme, or the European allowances, hence this EUAs thing. And that is, first of all, it's a massively different market. We're talking about a 700 billion market, and down here is the voluntary carbon market. So it's really tiny. This thing makes a huge amount of noise because people understand let's plant a tree. Whereas this is a bit more complicated to explain, but actually, once you understand it, once you get to grips with it, it's the only commodity in the world, if we call it a commodity, I call it an asset class maybe, where I have absolute understanding of what the demand side is doing and the supply side. And that's pretty unusual. I mean, I can't think of any other commodity where you can do that. It's very different. It's much bigger. What it is about is forcing companies to reduce their pollution levels, whereas the voluntary carbon market is you may choose to offset as much or as little of the pollution of which you can produce as much as you like, and it's completely up to you. So it's not.
And those offsets may or may not be real, and they may or may not have effect.
Yeah, exactly. I mean, they fall down on ESG metrics, they're opaque. Not only is this market much smaller, you've got to divide that into about 10,000 different projects. It really is. I mean, it may be liquid getting in, just like an IPO, but to get out, good luck for most of those. And there are conceptual issues about, if you say, right, this project is a 200-acre forest, and we're going to plant however many trees that is. Eventually, one of those trees is going to fall over and die, of course, and you have to replant. Well, that's mostly in all these projects, they take account of that. But what they don't take account for is that tree's fallen over, it's now decomposing and releasing the carbon back into the atmosphere. So actually, you need to plant more trees always as one tree dies. So that forest of 200 acres really should grow effectively to infinity. So to really different markets. The thing about the EUA, it is, or the EU Emission Trading Scheme, as it says, it is EU, it is regulated. And I'm going to say one thing on regulation, right? I've covered utilities for 35 years, so I've gone through a lot of regulatory systems, and I don't like regulation as a rule, except and it only really works in your favor as an investor when you're back against, when the politicians are against the wall. So, for example, when Brazil was running out of hydroelectric power decades ago, I had a fight with the energy minister, and we had a fisticuff via Bloomberg and Reuters and all that sort of stuff. Anyway, he departed pretty soon when Brazil did run out of energy. And because of it, they ran out of energy. They then put in a whole raft of new regulation, which is really good for investors. And I've seen that time and again. And in this case, in the EU, what they've just done is say, look, we are super committed to reaching our 2030 climate goal. It was a 40% reduction on 1990 levels. Now they want to reduce it by 55%. And what's more, they separate that into two. Once you break that down, that EU 55% goal, you've got the non-EU ETS industries and the EU ETS industries, which are about 40% of emissions, these guys have not reduced their emissions by 55%, but by 62%. Right, so it's an even bigger onus on these industries within the EU emission trading scheme. So, in a nutshell, every single year the level of auctions of these European allowances come down all the way to 2030. So that bucket available to industry shrinks and shrinks and shrinks and shrinks, which means if demand doesn't do very much, i.e. emissions don't do very much, and it'll take time for them to come up with new technologies and so on to facilitate that, then you get a tighter and tighter market, forcing the price up. And just one final thing so that people understand is that every 30th of April, if you're one of these industries, you have to go cap in hand to your government and say, right, forgive me, I have polluted 10 million tons of carbon, to which you then have to deliver these 10 million European allowances, carbon allowances, which you've either got for free in part and purchased via auction or other means, and you have to deliver those 10 million to your government. And if you fail, there's punitive penalties.
So everybody's essentially forced to buy this, which drives up the prices because the supply keeps going down. And in theory, it creates the behavior or the economics to force these polluters to find different forms of energy use. That's the basic idea, I guess.
Yeah, yeah.
And even more interestingly, they didn't make this an internal market. They made it a tradable market as well.
Yeah, yeah.
And what is the mechanism for trading currently these credits? Or the system? It's not a credit though, is it? It's a...
Don't call it credit because I'll spank you.
That's right. I keep saying the wrong word.
It's an allowance. It allows you to pollute. Right? A credit is to offset what you produce, kind of thing. That's the other tiny little circle I talked about. Yeah, I mean, the mechanism for trading is that, well, basically about half of the total allowances each year, or that bucket, if you like, are given away for free, which in practice means that industry, well, power gets zero, and they're about half the emissions, a bit more actually. They get no free allowances, and then industry gets about 85%. But overall, it's about half and half in percentage terms. So you get your free allowances, and then you've got to go and buy. And you buy because the EU has almost daily auctions, and that facilitates the market, so you can go and buy them that way. Or you may buy them from somebody else or whatever, but then you start getting this market. And financial participants are encouraged with a view that that facilitates liquidity, it facilitates price discovery, and so on. There's always going to be some politician out there saying, "Oh, the carbon price has gone up. I blame financial investors," but it's very short-sighted and stupid. And actually, it's not even true because if you think about, you've got all these major companies. You've got Shell, you've got RWE, you've got Uniper, all these guys, all oil companies, all chemical companies worth their salt in terms of size, and power companies have trading desks. So guess what? They trade, right? And they are also speculating. So to just say, oh, it's financial investors is gobbledygook.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.